Good morning. So it is September 11th, 2024, and this is a special day to remember all the victims of the atrocity that happened 23 years ago. And I wanted to just recognize that. 23 years ago, I woke up early to take a flight, and I actually flew on September 11th when the terrorist attacks occurred, and my plane was grounded, and I had to drive myself home. And it really hit me that I was fortunate not to have been on one of the planes, and I really felt bad for all the people that were victims to it, both the people that died as well as all the families that were affected. So I just wanted to mention that I really feel for all the people who were affected, and hope that never happens again. On the stock market, it looks like we had a consumer price index report, and it looked at core inflation as well as overall inflation. That's important economic data to consider as we begin to expect what is the Fed going to do with interest rates. So I'll take a look at the CPI report and form a couple of conclusions on where I think inflation's at, how it affects the economy, how it's going to affect interest rates, and how it's going to affect the stock market. So I'll get into that. Thanks everybody for joining. I appreciate it. Looks like we've got a good number of people on. And Do Me Trash, good to see you. And good morning. Good morning, Family Guy. Good to see you. And guys, if you want to look at a stock, please put it in the chat. We'll take a look at it. And I'm going to do a deep dive on GCT. We're going to do a full analysis on GCT today. And I wanted to go through the whole thing and see if it's a good company. It's a little company, so I think it'll be interesting. It'll be kind of discovery for most people, unless you've already looked at this little company. And it's a company that somebody recommended on the live streams. So every time I look at it, it looks good. So let's go even further. I'll take a look at Bank of America. Warren Buffett's selling Bank of America. What's the deal? Also look at Ali, because not necessarily the stock itself. I think the stock tanked yesterday. I'll explain what happened and what are the additional ramifications to the economy. I think there's big ramifications within that report. And I thought it'd be fun to take a look at GameStop. That's a stock that I shouldn't touch. I don't want to touch. And some people do, hopefully they have fun with it at least, because anybody who invests in that is probably going to lose money unless you're shorting it. But let's get into it. So it looks like the stock futures are going to open lower. The Dow futures are down. S&P futures are down. NASDAQ down. And hey, Mike, the dividend investor guy, I appreciate you joining. Man, you're all over this community. You're in Discord. You're on the live streams. I appreciate that. And you really bring it. Thanks for all the comments. Crude oil is up. And that's good because the darn crude oil is so low. I'm a Chevron stockholder, and I'm like, man, it's pretty amazing that it's dropped so much, but it has. It's good for the gas pumps. I know that when I drive around, I'm looking at gasoline prices. They're significantly lower. That enables consumers to keep more money in their pocket. So that is good for the economy. It is bad for Chevron stockholders. But hey, you can't have a perfect scenario every day. Looking at cryptos, the Ether and BTC is up. They've been having a tough time for the last 2 months, 60 days. And we'll see what happens. I think there's still a lot of fear in the market. I think there's fear, and investors are probably sellers in the month of September and October. They traditionally have been months where investors sell. They want to get out of positions. So not a big surprise. So let's see here. So Mike, oversell to me on Ali. I started a small position. Trader Prad. Hey, buddy. So Trader Prad's he's a trader, and I met him on stocks, and the his streams are excellent. If you want to take a look at that, I'd like to do some streams with Trader Pratt because I think I can learn a lot from him. He looks at trading from a completely different perspective. And I like doing that because I usually learn something that I didn't know before. So look for maybe a stream or two that Trader Pratt and I will do together. Good to have you. And then Mike, you're going to continue to dollar cost average into oil. That's not a bad idea. Buy companies when nobody likes them. And then when everybody begins to like them, the stock price rises. So that's, I'm going to try to dig up a graph that I think really shows that scenario well, because it's a recipe that's worked for me over and over again. And it's not that complicated. And I've got it here. So let me move it over to my screen. So what Mike's talking about is you've got companies that are really riding high. Everybody likes them. And for some reason, they just become unlikable, undesirable. The market just moves in a different direction, which I think like software companies have been neglected. Healthcare companies have been neglected because a lot of capital went to AI. AI kind of took everybody's interest. And those stocks really dropped. And, where I think Mike is talking about, and I like to invest, is in this buy zone. You're buying when nobody likes them. And then people wake up and they're like, holy smokes, those oil companies are producing a bunch of cash. They're paying a big dividend. With the stock price going down, the dividend rate keeps getting better. And boom, you buy and then it goes up. It's not rocket science. Or as Yogi Berra would say, it's not rocket surgery. And this is a recipe that I've followed on a number of stocks. And it's not like only, small caps go through this type of trend, or cycle, I should say. You can look at the Mag 7. Meta did this. Google's done this. You could see each stock go into this buy zone. I did this with 3M. More recently, I did this with Amazon. So this is a technique that, not even a technique, I would say, if you study companies, you understand them really well, you understand oil companies, you could use that in your advantage. Use the information advantage you have on industries that you really know a lot about. You can judge where, maybe the stock is being hated, but the fundamentals look great. Great. Thank you for the discount. I'll take it and buy it in a really good zone. So it's a good point there. And then Family Guy, are you bearish or bullish on markets today after CPI report? I'm going to answer your question, sir. I will definitely provide an answer to that. Mr. Shadow Guy, good afternoon, sir. And good morning to me. All right. So we know where the markets are at. The CPI report, it came in. I think it's not a lot of news. The only thing that came in a little higher was core inflation. But I don't think that was much news at all. The core inflation stayed the same. The inflation rate is at 0.2, and that's month over month. So if you multiply that times 12, it's 2.4. That's not bad. That's really good. Year over year inflation, 2.5. Remember it used to be 9 like 2 years ago? That was nuts. Now it's 2.5. I mean, I think this is a good inflation report. I think the Fed is seeing the markets freak out. They freaked out last week. They were in a lot of fear. There's a concern that unemployment is really moving up. Unemployment is the Fed is going to focus on two things: keeping unemployment low and keeping inflation low. Those are the two. And Now that there's evidence that inflation is under control, they cannot let unemployment get out of hand. And unemployment tends to rise very fast. If it rises very fast, they're going to get a lot of static. They're going to get a lot of, they're going to be called on Capitol Hill, and senators are going to, take the Fed through a lot of questions of, why are you letting unemployment go up? Because unemployment affects the population, it affects voters, and the congressmen and congresswomen and senators, they hear from their constituents on unemployment. So all that, I think, answering Family Guy's question, is the inflation report actually makes me feel more optimistic about the economy. I think if inflation gets handled, that was the biggest problem the Fed was dealing with in the last 2 to 3 years. Okay, now that we've tabled that, now that that's not a big problem, they can focus on unemployment. So I think it's a good report, and it's a more optimistic. I still think we've got the unemployment task to deal with. I don't think a recession that we might have is going to be all that bad. We may have a slowdown, but it shouldn't be too bad. Oil is helping the situation because oil really does have a direct pocketbook effect on consumers. If consumers are paying less for gasoline at the pump, they have more money to spend in other things. They have more money to spend on, restaurants. They buy something online. They do other things because they have more discretionary income. So I think the CPI report came in. I think it was a bit of good news. We have another report tomorrow. We have the producer price index report tomorrow, but importantly, jobless claims. So we're expecting tomorrow that it's going to move up a little bit to 230,000 new jobless claims, 231. This one here, if we were to get like 250 or higher, that's really bad news. I think the market will go down substantially because it's evidence that, hey, we're losing a lot of jobs and people are unemployed. We're going to go into recession. And the higher the unemployment, the uglier the recession. So that report is tomorrow. We'll see how it comes in. The consensus is 230. And, we'll tune in to this stream tomorrow. We'll talk about it. But those are the two that I was looking to read this week. And the first one I thought was, hey, that's positive news. Inflation is under control. So that'll help the economy and that'll help stocks. Okay, so just taking a tour of, stocks that are making noise. I didn't see there weren't many earnings yesterday. GameStop, announced their earnings yesterday. We'll take a look at GameStop just for fun at the end of the stream, if we have time. But nothing else kind of came up. One thing that I would mention is there's the IPO market. It hasn't been very active, but I don't really participate in IPOs. It's really, when you buy during an IPO, you stand to lose money just about every single time. I've yet to see like a solid IPO that IPO'd at a certain price and then kept going up. Sometimes they have a short-term rally and then they always nosedive. So I'm always waiting maybe 3 to 6 months after the IPO for a couple of reasons. One is I get a couple of financial reports through their earnings calls that they're going to have now that they're a publicly traded company. And that's really good information. And two, investors sort themselves out. You have some investors that were, pre-IPO investors that are offloading their shares. They're getting out of those companies, trying to, execute their exit strategy. And once they get all their stocks sold, it tends to drive down the price and you can pick up, shares in a good company. I've done that with Airbnb, Uber. And I think that's the approach that I'd rather have on IPOs. I don't know if the IPO market's going to get any better. It's been pretty slow and mergers have been pretty darn slow. which is kind of weird. All right. So, all right. Catching up on comments. So, Shadow Guy, just an aside, some countries go to negative interest rates at times. Yeah. Yeah. I have heard that. And what's unusual about that is, if you go to the bank and you put in $1,000, right, you're expecting, oh, they're going to pay me a little interest. And here, I think in the US, you're getting paid, call it 3%, 4% or so. Well, negative interest rates means you go to the bank and they go, yeah, we'll hold your money, but each year it's going to go down by 1%. It's almost like a management fee for your money. And which is interesting. And it makes me think that if those conditions were to exist, it would actually be a good tailwind. It would be favorable towards cryptocurrencies, because cryptocurrencies are very easy to hold in your wallet, digital wallet. You can move them around very easily. You can stake them. You don't need a bank when you have crypto. You don't really need a bank if you have cash, but you just need a pretty big safe. And it's very hard to transfer your cash. So that's interesting. Very good point. And then Mike, the dividend investor guy. So you thought that the market would be down after the debate. Yeah. So good. Yeah. Now I'm gonna talk about the election purely from a stock perspective, and I'll really try to stay in that lane. It's my belief, and I'm trying to look for a better word rather than belief. But as I look at historically, elections provide like more tension, but I do not believe that they move markets. It's not like, hey, this candidate is going to win, so the market moves fundamentally. Because the basis of my confidence in the stock market is my confidence in the U.S., my confidence in the fact that the U.S. has what I've participated in is a place where entrepreneurs can start their companies, people could get educated, really advance their careers and advance, their economic condition. Companies can go IPO and attract capital to grow. Ideas can really grow in the U.S. It's not a big surprise that so many like really cool companies like Apple, Microsoft, and I could go down the list, are just really, really good companies that provide products and services that help the US and the world. That's the basis of my confidence in the US. Politicians, although they're very important, they work with emotion, and I'm not a political analyst, but they don't change the base fundamental of why I invest in stocks. I invest in stocks because companies are creating value and they become more powerful, more important as they create that value. So that's the basis of my investing in stocks. And that doesn't change whether this politician or that politician gets elected. There might be a short-term bump or drop. There might be a little more tax we have to pay or a little less tax. At the end of the day, I pay my taxes, and that's what you have to pay for the army and all the other stuff. But that's how I think. I know some other people think that the election is really going to move the market. I don't. I think it short term might, cause for a sell or a rally. I think it makes October more volatile. It makes an extra layer of fear that I've been talking about. I do acknowledge that. I just think once we get into mid-October, literally like 2 weeks after the election, you're going to see that we're going to like forget about the election. We're just going to get on with it. I'm a stock investor. When I invest in stocks, I try to, kind of avoid all the rest of the noise. Investing in stocks is already so difficult. I try to simplify And I focus on fundamentals. I focus on that company if they're going to be able to operate and be successful. So the whole political environment is not part of my process. All right, so let's get going with Ali, and there's a purpose for that. Is that there's an economic message in the Ali Financial Update, and so Ali Financial is a good company, and I believe they used to be called GMAC, and General Motors had a financing arm, and they spun them off, and they called themselves Ali. Yesterday, the stock went down 17%. Ooh, man. And the reason for it is that the CFO is saying that consumers are struggling and delinquencies are rising. Okay. This whole, expectation that I have that we're going to have a recession. Here's one more data point is you have these guys do mostly automotive financing, and they do other financing as well. They do mortgages and they do other types of financing, but big part of what Ali does is automotive financing. And they're seeing that consumers are beginning to struggle, and that struggle affected their stock, because if Ali experiences higher delinquencies, that's a cost. That's going to affect their P&L. It's going to affect their cash flow. It's going to affect a lot of things. So, but it also is one more data point for the economy. The economy is 70% consumer, and this is a fact that the consumer is beginning to struggle, and maybe they are already struggling. If you think about the consumer today, it's very different than the consumer 2 years ago. 2 years ago, the government was pumping the economy with stimulus dollars so we can get through COVID, and people don't get too restless, because we were already locked up. We already had to wait until they came up with a solution to the whole COVID virus, and we got through it. But in the meantime, the government was like, "Hey, we're gonna send out stimulus dollars so that people have enough to operate with and eat and so forth." Well, those dollars became, in my opinion, disposable. Okay, the disposable income. People were to buy things. They were buying cars. They drove up the cost of cars, used cars especially. They were just sky high, and financing on those cars became really expensive for a lot of consumers. So all that's beginning to come together as a problem. If you recall, during the subprime mortgage meltdown, it was kind of a couple of variables that led to a really bad problem. High home prices, people that really didn't qualify for loans. The mortgage companies were exaggerating the numbers, I guess, making up the numbers, and getting people into loans that they couldn't afford under adjustable rate terms. And it was really not a good thing for them to do. But that created a bubble, and then it popped, and it became very painful for the economy. Almost drove a couple of insurance companies out of business. And the movie The Big Short was created to kind of tell the story of that era. Now, this little, automotive bubble, it's not going to move the market that much, but it's just an example of the things that I'm seeing that the economy is going to struggle with. We'll see how it plays out. But I thought it was a bigger story than just one stock, as the company announced. What I try to do is, all these little bits of information, they're like Lego pieces that help me understand the big picture. This is one Lego piece in that picture, and I thought I'd kind of share that with you guys. Hey, Bad Omen, good morning. All right, so we got through Ali, and let's talk about B of A, and then we're going to get into GCT. So B of A, banking in 2023, I'm going to show a chart. So you guys remember the Silicon Valley Bank, right? And what happened with Silicon Valley Bank is that when the Federal Reserve, said, "Hey, we're going to beat inflation by raising interest rates and making interest rates much higher," The market's beginning to recover. That's good to see. The interest rates, and probably the most darn. This is one thing I hate about CNBC is they do like too much advertising, and you think you're going to click on something, then they move it. And I think they do that on purpose so you can click on one of their ads. See, it did it again. Oh my God. There we go. Okay. So if we look at the 5-year, so you saw that we went in 2020, we were pretty much near zero. And then the Fed said, okay, inflation has become a problem and we are going to go way up. And it's, I think, the fastest rate of increases since like the early 1980s. So it was just a rise in interest rates. And what that happens when interest rates rise, the value of bonds drop. So if you have a bond and it's worth $1,000 when you bought it and it pays a 1% interest rate, which I wasn't buying bonds back then, it's just not a good deal. Then you're like, okay, this bond is worth $1,000 and it pays a 1% yield. But if interest rates go up to 5%, those bonds, in order for them to be marketable, you have to drop the price from $1,000 to $800, $700 in order so that you can be competitive with the yields that are being paid, which are more closer to 5%. Now, Silicon Valley Bank had a lot of bonds on their balance sheet, and banks tend to have long-term bonds as one of the main interest generators for their bank. And banks, the way they make money is they're earning 5% on their long-term bonds, maybe 6%, and they lend out at 10%. And the difference is net interest margin, and that's their profit. What happened with Silicon Valley Bank is when interest rates rose this fast, they had to, using GAAP principles, generally accepted accounting principles, they had to state that, hey, we lost money on our bonds. It was a paper loss. It wasn't a cash loss. It wasn't like, oh, we had to pay out all this money. But that scared the market. And there was a run on Silicon Valley Bank, and that bank doesn't exist anymore. The reason I say that is when we look at the Bank of America chart, you're going to see that banks were really sold off and created an opportunity for investors. So we had in 23, this is when the Silicon Valley Bank, scare started. All these banks were just sold off. Bank of America was sold off 30%. This is one of the best banks in the US. So the buying was great. You remember that chart I showed you is you want to track companies that are quality. And then when everybody's afraid, oh my God, Silicon Valley Bank went bankrupt, or there was a run on their bank, it was a great buy zone. So you look at B of A, it looked great. I bought Citibank and I also bought a US Bank because of this trend. And I thought, the market's crazy. Yes, Silicon Valley Bank had to write off their bonds, but it was a paper loss. It wasn't like they had to dole out money. It was a paper loss. And these other banks will have to restate their long-term bonds, but they also will be paper losses. So I'm doing well with Citibank. Here's Citibank, and over from here to here, and it's not going to show it to me, but it's not a good comparison. I'm going to get rid of it. So B of A, from the very bottom to where they're at now, it's a 56% return. So that's a very good return. Now, Warren Buffett keeps selling off B of A, and I continue to hold my Citibank. I think it's a good stock. Citibank pays a good dividend. I think from a book value perspective, and banks you have to value differently. I don't use the intrinsic calculator that I've shown many times. With banks, I actually look at book value and I look at earnings per share. And Citibank, I think, has the best ratios and has the best fundamentals for me. Bank of America is also a good bank. And what's their dividend rate? So they pay a 2.65% dividend. And Warren Buffett made some money. I mean, if he bought at the right times, like here and here, there was good money to be made. So it's interesting that he's selling it. I don't understand why. He sold a lot of Apple, and now he's selling a lot of Bank of America. Citigroup is down a bit. They were down quite a bit yesterday. So for the 1 year, it's up 41%. Thank you very much. And they pay a nice dividend. So I'm good. I'm sitting on a nice gain, and I'm getting paid really good cash flow. So banks became a really nice opportunity. It's an opportunity that the market pretty much, gave us. Like, hey, we think banking is, undesirable. The other backstop to banking is that, the government's not going to let too many banks go under. Silicon Valley Bank, got acquired by another bank. I forgot which one. Their account holders were made whole, but the stock itself, stockholders, paid or lost their investment. But that was it. They contained it to that one bank. And the government does not want to run on the banks. That just becomes really ugly. So I kind of expected that would be the case. And then that market really recovered. So it's interesting that Warren Buffett's selling off Bank of America. But that's just one more example of how, study quality companies, wait for them to be in that buy zone, and you can make money and really play that in your favor. All right. So let's get into GCT. And this is that little, I'm going to call them a logistics company. And I view them more of an industrial stock, because like UPS is an industrial stock. But they're listed as a software infrastructure company. I don't agree with that. They're more of a logistics. They deliver big packages like a sofa, a stove, that kind of thing. And that's not something you can ask UPS or FedEx to deliver. They have certain limitations on their parcels. This is a tiny company, tiny. And then revenue, $1 billion. And what's interesting is these guys are headquartered in El Monte, California. Now that's probably about 25, 30 miles from where I live. And I could probably drive by their location. But their growth is really impressive. Now they're small, but their growth is impressive, and they're making money, and they are generating cash flow. So I've kind of taken, the viewers through GCT yesterday, and then I tried to use the calculator, and the new software I'm using, it's the Excel. That's the web version. Didn't want to work for me, but I think I'm ready to go. Famous last words. So yeah, let's go ahead and update it. And what I'll do is I'm going to open up another tab so I can view the fundamentals, fill them into the spreadsheet, give you as much screen space as I can. That way you can see everything that I'm doing and kind of go through the whole review. Now, before I jump into the calculator, I wanted to do one more thing, which was I want to actually go to their website. Let's get familiar with the company, because this is a little company. And with a little company, I have to get to know them a lot better. And they're in El Monte, California. So they are, they deliver big stuff, furniture, big heavy items, B2B marketplace. So they're into ocean freight, warehousing. So they're like a logistics partner, right? Where you can have, let's say an appliance company is like, hey, rather than us leasing out the warehouse space, they can go to a 3PL, a third-party logistics company, but they tend to move in bulk. Like we'll move bulk to a warehouse. These guys, I believe, will warehouse your inventory and then do the last fulfillment event. Like we'll deliver that, washing machine to this address in Chicago, that kind of thing. And then reliable fulfillment is what I just talked about. So that's what they do there. So this is their founder. Okay. They're part of the Russell 2000. All right. That's good. And they had a B2B marketplace. So I understand their business, right? This type of logistics, professionally, I've worked in environments where I've helped companies modernize their warehouses and logistics. So I understand this industry quite well. Okay. So here's examples of what they're doing. Just big stuff like this paddle board. How do you deliver that paddle board? You know, UPS is not going to do it for you. The Playhouse, you know, these types of things. That's what they're trying to deliver. So they make themselves different. They're not like UPS. They're not like, you know, FedEx. And if you look at the trends of shopping, right, you know, you have people buying online. They're buying just about everything online. They're buying cars online. They're buying appliances online. They're buying all this stuff. And you see people go to the showrooms, go find what they're looking for, and then shop it on e-commerce to get a better price. And these guys are going to keep growing because the trend is their friend. The trend of online sales keeps getting bigger and bigger, especially for these big ticket items that are very bulky. So I like where they're operating. They're different. They have uniqueness to them. I'm good with their business. I would say they're kind of like straddling the gray and the green, probably more gray than green. Let's face it. They're a little company, so they're not going to be overly competitive. They're not going to be able to fend off competitors. If UPS decided to throw a bunch of capital into this part of the business and start a little, you know, side business or acquire somebody, they would be a direct competitor to these guys and they'd be under threat. So I'm going to put them a little bit green that, hey, I like your uniqueness, your differentiation. I like a lot of things you're doing. So let's see where the fundamentals land. These fundamentals don't represent Giga Cloud because this is for another company. So their market cap right now is $758 billion. And shares outstanding are 41,036,000. And when we look at their financials, and that's another thing I wanted to look at is I wanted to look at their financials from their website, not necessarily from the stock analysis website. So investors. And it's a good idea to always get familiar with a company's investor website because you'll see events that are coming. And I like to look at their P&L, the way they produce it. Sometimes some of the aggregators like Yahoo Finance or Stock Analysis, they tend to kind of bring multiple lines together and summarize them. And sometimes I want to see the whole thing. That way I really get a better sense of the business. And they're going to repurchase program. Okay. So here's this. So here's their announcement on August 6th. So they went revenues, 310 million, which grew 103%. Awesome. They have gross profit increased. Okay, good. Net income grew 46%. Very good. Growth in EBITDA. Cash and cash equivalents, $208. Okay, that's a number we can use, right? So $208. I'm going to write that down. 208 million in cash. Year to date looks good. All right. Business outlook. The third quarter is going to be 266 to 282. So 266 to 282. Okay. And okay. So here's your balance sheet. Do they have any big debt? So they have leases of the buildings that they're, you know, operating in. I don't like to include that because everybody has leases. In their case here, it's a direct part of their operation, right? They're providing logistics services. So I don't really consider it debt. I know some people would, but I don't. And they don't have any other debt. So that's good. Accounts payable, contract liabilities. Okay, good. We look at their income. So you have service revenues, product revenues. Okay. So this is a little bit of a surprise. And I'd want to know, are they stocking product and then they're basically offering it to e-commerce sites so the e-commerce site can say, yeah, we can sell you that item, but they're really selling some of this company's inventory? That'd be interesting to find out because that's a major part of their income. So that would be one homework item. I'd want to know, what is that all about? That is a little bit of a surprise. I expected most of the revenue to be service revenue because they're providing the logistics for, the large bulky items. Okay. So cost of revenues. So when we look at gross profit, they're 153 million in revenues. I'm sorry, look at the wrong year. 310 million in revenues, and their gross profit was 76. So they're at about 20, 22, 24% gross margin. They're a services business. So if you looked at UPS and places like that, you'd see that that's consistent. All right. And on the product side, so you can see that their margin is a little bit better on the product side. Okay. So not much interest income because they don't have much debt. They don't have interest expense because they don't have debt, but they have interest income of $2 million because they carry a lot of cash. They're going to start buying back shares with that cash. That's positive. When we look at cash flows, a income statement is produced using generally accepted accounting principles, and it uses accrual accounting. And that at times, it makes a company take expenses in the period it was incurred or earned. And that tends to be a little bit fuzzy, a little cloudy. Charlie Munger didn't like the income statement. I think most investors, if not all of them, they rely on the cash flows because cash flow statement basically takes out the accrual accounting effects and gives you, this is the cash. And you can look at a cash statements for the last 5 years and establish this is the amount of cash this company produces. There's no accounting in there. They've extrapolated all the accrual accounting in there. So the 6 months, 24, we're at net income of 54 million. Something that was in effect was deferred tax. It looks like they paid some deferred tax. And then share-based compensation, they added it back. Operating lease increased. So their leases are increasing, they're growing. So they're probably leasing more space. Makes sense. Okay. Totally understandable. We have inventories went up. So the inventory more product. Now, we've been talking about a slowing economy, and these guys are selling bigger ticket items. So the inventory line is a concern because they don't want to be caught with inventory that is then going to be stale and potentially they have to write off. And frankly, the capital is being tied up in inventory. So that'd be an important line, and I noted it, to keep track of is, why is your inventory growing, and is that a problem? Is that going to be inventory that's going to get stale? Because, I'm not an expert on furniture, but I think there's certain like trends and like fashion, right? Something's in 1 year and then not the next. Is furniture the same way? Like 1 year, everybody wants to buy this type of furniture, and then 2 years later, nobody wants to buy that kind of furniture. They're buying something different. That could be the case. So inventory has to be an item that has to be explained. That number's too high. And then we got accounts payable. It looks like they increased their accounts payable balance. So they netted out $34 million for the first 6 months of the current year in cash from operations. Now we need to take out plant, property, equipment, which is also referred to as capital expense. Those are expenses to put back into the business to keep operating it. And when we deduct that 10 million from the 34, we get 24 million for the first 6 months of 2024. If we go times 2, it's 48 million. So we'll use that in my calculator. Okay, so we didn't have debt and we have the cash amount. We'll get earnings per share from, did they guide their earnings per share? Let me see if I can get it from stock analysis. So, their earnings per share is going to be good at $2.93. And then it's going to grow at like 25% for 2 years. That's very good. Okay. So we decided on the first half. This is the first half number. And we're going to go times 2 times 1 plus growth. Okay. So it's 48 times 2 times 1 plus this growth rate. And the growth rate I'm going to put at 10%, and that might be a little conservative, but that's all right. It's a small company. This is a tiny company with no debt. I understand their industry. I'm going to go with a 10% discount rate. Long-term growth, 4%. That's fine. I'm actually going to go 15 on that. Okay, we're good with that. So the intrinsic value is $2.2 billion, and they have $208 million of cash, no debt. And this is greatly discounted if you look at cash flows. And if they grow the way they've been growing, they become a $2, $3, $4 billion revenue company. Holy smokes, man. This one looks really good. Let's finish with earnings per share here, $2.93. So PE, this is a small company. It's not a highly desirable space, but it is logistics. UPS, FedEx, those companies, they carry really, really good valuations. We can be conservative with the 12, and I'm going to go with 15% growth. It's stated that they're going to grow at 25%, but I'm not going to go that high. And what's their current stock price? 18. So this is an opportunity, but it requires a lot more homework because this is a small company. I can't just I believe everything I'm seeing. I'm going to do some more homework and settle in on whether I'm going to, for sure, the fundamentals look great. Revenue growth looks awesome. I like where they're playing. I mean, this little company is, again, they differentiate in a way that I think is, it really makes a lot of sense. They're latching into the e-commerce space, which is not going to get any smaller. It's getting bigger, and they're making themselves different, which is very good. And I think they're touching the green, but mostly in the gray. So I like the company. I like the company. I like what they're doing. I think it was smart. It's a necessary service to keep the e-commerce economy working. So I like those aspects of the company. The fundamentals look good. I just got to go do the homework on what's the story on these product sales. that was a little bit of a surprise. Why are you selling products? So I want to read more. I'm probably going to read into this maybe for an hour, maybe a little longer. I'm not going to keep you during all that. And then I also want to know what's going on with your inventory. Is that going to be a problem? I may want to wait a quarter and see where their inventory balance is in a quarter and see if it came down. If they have any comments towards that. It's such a small company that I might join their conference call. And sometimes if you join and you use the number in the, yeah, so you can dial in, and they're so small that I'll probably be able to ask the question of inventory, explain your inventory and tell me about that. So that's the advantage of a small company, is you get to ask questions. If you call into one of the big stocks, they're not going to take my question. They're going to go like the big, brokerages and all the big analysts and answer their questions during the time. So this company, I wanted to highlight because it's just a neat little company. I think it makes a lot of sense. There's always companies out there that are good ideas, and it may not be a perfect idea right now, but maybe eventually, and maybe right now might be a good idea. I'm just not done with my homework, and I'm going to keep doing that. So I'm going to keep studying the company, make sure it's a good investment. So that's GCT. It's looking good, man. Every time I touch it, I'm like, looks good. Looks good. It's just small, so I'm being careful. All right. So Android PC. You prefer SoFi? We're talking bank investing. Cool. SoFi is growing much faster, and a lot of people like SoFi. Ali, by the way, has a bank. The problem that I have with SoFi is they don't make money and they burn cash, and that's a problem for me. I like a company that, I've had too many stocks that were like really young stocks, cost me capital. I lose money. So I wait for them to really have momentum and really prove that, hey, they're going to be around. They're going to be a good company for a long time. I can't say that SoFi has made it past that threshold. I prefer Robinhood if we're going to talk small, and Robinhood's done really well. SoFi does have very good growth. Revenue growth, 30%, 36%. Their interest income, overall, I think from a growth perspective, it's a very good story. Just where the valuation breaks down for me is they lose money and they're burning cash, and that's going to be a problem eventually. So, but you might be right, and I hope you make lots of money on SoFi. It's just not the right one for me. So Mike has automatic reinvestment. Very good. I did not reinvest my big Chevron dividend. I have the cash. Took my wife shopping. She didn't buy much though. I said, hey, buy something nice. And she bought a nice blouse, but that was it. All right. So yeah, so you can set, I think my brokerage, you can set for your dividends to reinvest automatically or not. And I think you have to do it is it on a per stock basis or for the whole account? I forgot, but you have that option. Yeah, good stuff. So I'm caught up on the comments. Since we have a little time, let's take a look at the market. Then we're going to potentially look at GameStop. Because, man, we're in the red. What is the deal, man? We had such a good Monday. We had a real positive Monday. Last week was horrible, right? So we had last week and we went way down. That's just a part of last week. And then Monday, hey, now we're talking. And Tuesday was somewhat flat. And then today, we're still up for the week, looks like. Oh, no, sorry. We're still up for the week. Hmm. So the market's trying to digest the CPI report. I wonder what industries are doing what and what sectors are doing what. So right now, it looks like technology is leading the pack. Real estate's doing the worst. Industrials, staples are bad. So the fact that staples are selling off, I think the investors in those companies see the CPI report as positive news that is good for the economy, but it's going to be bad for consumer staples potentially. Then we have financials down, consumer discretionary down, healthcare at 55, 0.55 down. Energy is doing okay today. That's surprising. Oil prices were really high. So what happened to oil? It's not showing me oil anymore. Materials, communication services is almost flat. So interesting day of trading. So the markets are opening. Coinbase is down, Ether's up, and BTC is up. Interesting. Okay. VIX is up slightly. All right. So it's going to be a strange day. We'll see where we end up. It's only 30 minutes into the trading session. I'm not a day trader, but I like to see where the market's at and see what I want to buy today. It's like going down to the market and, oh, they've got the tomatoes discounted really low. I think I'll make this for dinner with those tomatoes. That kind of shopping. I already have, on my analysis, I have, actions already kind of preloaded for my stocks where I know which stocks I want to buy, but I look at the market and wait. If, let's say a stock that I want to buy is down 1%, boom, good time to buy, and I'll go for it. Yeah, so it looks like you can check off, your dividend investment preference. You can check off and say, hey, I want to reinvest the dividend in the same stock, or I want it in cash. FYI, if you have a brokerage account with the event is taxable, whether you reinvest in the stock or you take it as cash. If you're in an if you're in a taxable account, you will pay the tax. So that's one thing to consider. In my case, I'm in the highest tax bracket, and I prefer to take the cash because I've been paying the government taxes each year. So sometimes I'm like, yeah, I need a little more liquidity. I love the stock, and if I want to buy more, I'll buy more. But those dividends, they're going to be taxable, and they're ordinary income, and I'll have to pay the tax. So on Chegg, I'm still nibbling on Chegg. I still think we're going to wake up one day and it's going to be a 4-bagger, and I want to be a part of that. So that's where I am with Chegg. So GameStop. So this is GameStop it's like, I'm in California, so we call our highways freeways. I think in other parts of the country, they call them highways or the turnpike. Anyway, so let's say there's a part of the highway where accidents tend to happen there all the time. And you're driving past it, this morning. And once again, you see the siren lights and there's one more accident, and don't look over there. Okay. It's a car wreck. Focus in front. So that way you're a safe driver and you don't slow down and cause more traffic. But I just can't because it's too fun. Our friends at GameStop, I mean, look at this. Holy smokes. I don't know why anybody would want to be involved with this. It's the valuation. If you look at GameStop from a value perspective, the stock is not worth. And just a quick background. So I'm a very happy father of 2 sons, 2024. And my sons, they've always had computers since they were, 2 years old. And they had game consoles because I'm a software professional, and I believe that's really part of the learning that children have to establish to be really good with technology. So I bought them so much stuff from GameStop. I probably spent $5,000 to $10,000 on GameStop collectively, on consoles, games, peripherals, you name it. We bought it at GameStop. I created a vintage arcade in the cabin, second home, and did this vintage arcade. And GameStop, I knew the manager well enough because I was going in there with my kids all the time. And while they shopped, I talked to him. He gave me all these free posters of stuff that they weren't going to use in store. And I decorated my 600 square foot game room that we created. So I have a lot of history with GameStop. I'm a fan of GameStop. I would like their business to work. But the reality is retail is tough. Retail is like one of the toughest industries. When we talk about what are the desirable industries that I want to be in, retail is right here, especially discount retail. I just do not want to touch it. If you gave it to me, I'd sell it right away. I just don't want to wake up, from time to time and see that, oh, one more problem. Oh, one more issue. So no, thank you on retail. So the industry is tough, but their valuation's really high compared to their peers. We look at all this red, just red, because gaming has gone online. Kids are buying, they don't even have to download the games. They play the games on their PCs. They log into a server, they're good to go. And that just really, all the trends are moving away from GameStop. Okay. It's just reality. It's a new paradigm. We're in a connected world with high-speed internet. Companies are using the cloud. Gaming companies are using the cloud to provide their games to their customers. So it's basically eliminated GameStop from the equation. Fundamentally, I don't think anybody's going to argue with me on that one. So the revenue is crashing and burning. They are burning cash. So, okay, you're burning cash. Your revenue is dropping. You did it. They did take advantage of the stock price that really went up, and they issued out shares, which is how they're providing liquidity. They have $4.2 billion of cash because they issued out stock, which liquidated the number of shares. It made each share less valuable. So they have cash, but they kind of screwed the existing shareholders when they did that. And they have very little debt. So that's the situation there. So their valuation's about $8 billion. They have $4 billion in cash. So net about a $4 billion valuation. But they are burning cash. And were they losing money? So the forecast, one analyst, one brave soul, says they're overpriced by 50%. He thinks their earnings per share is going to be 2 cents this year, and then it's going to be negative. So this thing's like, it's one of those, highway, automotive accidents. Once again, GameStop, it announced their earnings. The stock went down substantially. The last 5 days it went down 9%. We'll see where it goes. I don't think GameStop has a place or a big place in the economy in the future. If you look at you remember how Blockbuster, man, there was Blockbusters everywhere 25 years ago. Like they were everywhere and we could go rent movies and enjoy those movies at home. There's no Blockbusters anywhere now because the trend was we're going to watch everything and stream it on Netflix or whatever you want to stream it on. That's what's happening to GameStop. So we'll see how quickly or slowly that happens, but that's my expectation on that company. So All right, so let me catch up on comments. So Michael Anthony, what about HPE with a great dividend, which is buying Juniper Networks? Yeah, let's take a look at that one. I haven't looked at HP Enterprise. I own HPQ, which Hewlett Packard, they became two companies. One took the consumer products, HPQ, and then all the technologies they were selling to businesses was Enterprise, HPE. Now these guys do produce good cash flows and they have a good dividend. Let me see if I have these guys. Are these guys on my watch list? Yeah, they're on my watch list. So I have a valuation for them. And right now they are so 15. So based on the last valuation I did, is these guys are discounted by 61%. Now the things that there's positives and negatives. First, it's a low valuation, 20 billion, and they have 29 billion in revenue. Net income, that's a really nice net income. They're doing about 9% yield on net income no, not 9%, it would be about 7%. So that's good. Shares outstanding, earnings per share. Oh my God, earnings per share 1.4, and then the PE ratio is 11. Forward PE is 7.8. Dividend is 3.2%. Not a bad dividend. If we look at their stock chart, not bad. I mean, it's upward, right? If you bought here, if you knew that this was a good company and they're going to be all right, you're looking at a pretty good return over 4 years. So that looks okay. Analysts say it's a buy and it's discounted. Trailing 12 months. See, they're kind of like slow grower for the last full years. The last 3 full years, they were a slow grower. Trailing 12 months looks like they've lost a little bit of revenue, but last quarter they did really well. Okay. All right. Interesting. So I think this is like a slow growth company. They're just kind of barely growing. They are a little bit big, but it's a slow grower, which it's not desirable. Free cash flow, 611 million. Multiply that times 10, you get to 6 billion. They have a market cap of 20 billion. Wait, I think I looked at the quarterly. So free cash flow, there we go. So 2.7 billion. You see that their cash flow has been positive for the last 3 full years, and then the trailing 12 months is 2.7 billion. Multiply that times 10, and we get to 27 billion. And they are discounted, just back of the napkin. And then I'll show you the valuation in a minute. So the analyst, 12 analysts cover it. That's pretty good analyst coverage. And they're saying it's discounted. So this is like a value stock within technology. They are profitable, expected to grow. So that looks good. This is a solid, kind of a little bit of a boring old technology company. Now the positives is really established businesses. Okay, that's good. They're going to acquire Juniper Networks. Not a bad idea. The negatives are that in a lot of ways, the technology industry just continues to get better and better, and innovations are coming out all the time. And I don't know that Hewlett Packard is near the front of the pack when it comes to technology innovations. They're probably closer to the middle, maybe towards the back of the pack. And that is a big risk long term. Are they going to be very relevant in 5 years? I don't know. In 10 years, I doubt it. The relevant companies of today, it's very cloud-based. Compute is really a commodity. GPUs are all the craze, so NVIDIA is just exploding. Well, those are spaces that Hewlett Packard Enterprise is not in. They're in the old school. You buy servers, you bring them into your data center, you set up these servers. They have industry solutions that are in place. So you're kind of dealing with legacy technology when you deal with Hewlett Packard Enterprise, and you're not dealing with like near the front of the pack technologies. So that would be one thing that I would be concerned with. I'm not a current stockholder of HPE, even though I think they're discounted. I don't buy into the company, and I have to buy into the company. I have other technology companies that I own, and I'm good to go on technology. So this one's not one that I'm investing in. Let me update the valuation model since you brought it up, and I've got it in here. And before I do that, let me just add GCT in here. Okay, so last time I updated it was a couple months ago, so now I'm going to update it today. I did do a video on it in March if you want to look at that video. It's a solid company, not too much debt. Their free cash flow guidance was 1.9 billion. I mean, I could leave it at that number. The stock price is $15.95, so it's gone down since March. They're still really discounted, and their run rate is actually above 1.9 billion, but they did guide to 1.9 billion. So I'm going to keep that number. I'm expecting their free cash flow to grow by 6% in the first 4 years and then 3% into the future. So the company has a lot of value to it. It really has a good discount to it. I need to update that number. But the stock price did go down recently. I just don't think it's one of the stocks in technology that people are really excited about. On the forecast, we've got earnings per share 196, so it increased a little bit. And I'm going to go with 12 there. Yeah, I mean, it's a discounted stock. I just can't cross the threshold of believing in the company. And I know technology really well. I have other technology investments, so I don't need dividend stocks. I don't invest based on dividends. I'd rather see a stock double in value every 2 years or 3 years versus, oh man, it's paying me a 6% dividend. Dividends are kind of a plus, an extra feature, but the base investing plan or thesis for me is the company is going to go up in value. Every 5 years, it's going to double in value. That's the basis of my investment. And I don't believe that HP is going to double in value in the next 5 years. I think they're going to bump along, continue to exist, but not be a very valuable company. And I don't think anybody's going to acquire them because they have old legacy technology. They're not a new player. They're an old player. So that is my thoughts on Hewlett Packard. So let me get back to the comments. All right. Did I buy CVS at the lows? I haven't traded anything today. So CVS, man, I ended up getting out of CVS because I'm like, some stocks, they just don't work. The fundamentals behind CVS are positive. It's healthcare. I like healthcare right now. The dividend is really nice for dividend investors. The PE is super low. Just a lot of things tell me CVS is unappreciated. They should be doing this, but CVS keeps going down and down and down. It's like geez, man, at what point is this thing going to turn around? And it just, you know, I got out of the position. I'm out. At some point, it may come back. But I do believe CVS has a valuable business. I do believe that their business is different than just being a retailer of pharmaceuticals, a pharmacy. They have the healthcare payer business. They're providing healthcare services in their locations. I like what they're doing. It's just the stock price is like terrible. And it's like, for Pete's sake, man, when's the market going to recognize their value? I don't know, but I'm not buying today. I'm just going to wait it out a little bit. I have plenty of healthcare stocks. I've got really nice stocks that are doing great, and I'm happy. The healthcare space, I think, is going to do well over the next 2 years, and I'm glad that I'm invested in it. So that's where I'm at with CVS. Dell is being added to the S&P index, meaning a lot of funds will buy into it. Yeah, that's good news for Dell. I think I have Dell on my watch list. And they're discounted by 19% based on $102 stock price. What's their stock price today? So I think Dell's pretty good. They have a good PC business. They have a good, enterprise business. They're just not like a stock that I expect is going to double. Much of the appreciation in the stock has already happened. And they have benefited from the whole AI build out trend. But if you study their revenue, it's not like they're exploding. They're just doing okay from a revenues perspective. But you can see that, hey, data centers are going to be massive for AI, and their stock's really appreciated. So I feel like I already missed the move on Dell, and the market has recognized that, oh, maybe we priced Dell too high, so it's really sold it off by 34%. I'm not buying Dell. It's like there's no long-term value for me. The stock's priced a little bit high because over the last 2 years, it's just really been run up. And, before AI, this was a $34 stock. Now it's a $105 stock, triple. So I think any good trend that's supposed to happen for them over the next couple of years is already priced into the stock. It's not a stock that I expect it's going to, double in value in the next 5 years. All right, so Palantir is as well. Yeah, Palantir is going to be added to the S&P. So Palantir, where do I have? I think I follow Palantir. So I think Palantir is priced at a premium of 45%. They provide an interesting software, but I think the market is really excited about the stock, and they don't really I study the fundamentals, and based on the fundamentals I'm studying, the stock is priced too high. It's priced too high by 51%. I think Palantir's business could be disrupted by Microsoft or one of the big software companies that wants to grow in that space. I know that Palantir came in and filled that space. They've done a good job. They're growing, but I just think they're priced a little too high. All right. So yeah, Agilent was a spinoff of HP way back when in 99. That was positive. I think Agilent did well. And then Victor, how is your put selling going? So my puts, I sold puts and they're going well, especially like some stocks that I've sold. Let's see if I can show a couple. Well, I've sold a couple puts where they're going to expire and I'm going to make the premium, no problem. With the exception of Citi. Citi, I sold a put and it's in the money. So I'm going to have to buy Citi shares. No problem. I'm good owning more Citi. But all the other ones, the premiums, I'm going to earn the premiums without any buy event happening. And I'm looking to refresh my options because the first ones are going to expire this Friday. And then next Friday, I probably have about 6 or 7 option contracts. So I'm going to refresh that. I wanted to get, last week was a week where I wanted to preserve my cash. I'm like, whoa, where are we going with this? I bought $6,000 at Amazon last week. That was my biggest move. This week, I'm not quite sure what the market's going to do. Monday was a relief rally. And now we're operating with, hey, let's wait to see how the news sorts itself out. It looks like the NASDAQ is now down 0.86. The S&P is down 1.36. Holy smokes. Might be a good day to buy stock. Might be a good day to look for this situation and go pick up some more shares of companies I want to own. So, but I think we ought to maybe, let me prep for tomorrow's call or maybe Fridays and kind of show you the options that I'm in. And I know Shadow Guy, you've got really good comments on options. I'd really appreciate everybody else kind of joining the conversation around options. That'd be interesting. So look for some of that to happen. All right, guys. So that was definitely a very good session. Thanks so much for joining. Good luck trading today. It looks like it's going to be down. So if you're looking to buy shares, might not be a bad day to pick up some shares at a discount. Let's see how this economic data sorts itself out and what kind of market we're dealing with this week going into next week. So, all right. So good session. Thank you all. And hope you guys enjoy your Wednesday. Take care.